Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Well, another eventful weekend with a bailout of Credit Suisse. Oh man, bondholders, shareholders absolutely hosed on that deal. That is going to have interesting repercussions for the future. But as a result, we have our treasuries are a little bit higher this morning. So last week they were kind of pricing, they'll still do the 25 basis point hike. Now I'm not so sure. We're going to have to go and look at what the short, what the bills and everything are saying. But yeah, we'll come over here to our screen. We are up almost to the 116 range. So let's come over to the charts and you can see here, of course, we were a little bit elevated on Friday, but then you can see over the weekend a little push higher. Although at the moment they are coming back. So who knows, maybe they come all the way back this morning. Here's the S&P 500, still just kind of chilling around that 30, between 4,000 and 3940. So that's actually really good for equities. I would expect them to be significantly lower. Oil still being like, oh, this is so bad. Natural gas kind of starting to fade a little bit. Gold, though, man, taking off, breaching 2,000 this morning. I am just stunned by how quickly gold came back. Like, it's been like, this terrible trade for such a long time, and then just all of a sudden, boom. Man, just an amazing move in gold and silver. Silver not quite recovering yet compared to gold, though. And then we got copper. Copper just still kind of middling there. But and Bitcoin also higher. This is getting kind of silly over in Bitcoin. And the dollar not looking so hot, getting now down below 103 this morning. So this could be interesting because here's the thing. I mean, we just had a big event kind of happen here with Credit Suisse. So one might think, oh, okay, we should be in the recovery mode now, right? But I'm not so sure, because the problem is that the issues that we're having aren't the kind of issues that just go away. I think that there's still a lot of banks out there in trouble. In fact, I saw a study yesterday suggesting that there was some like 150 or so regional banks that were kind of at risk of deposit flight if or of going under if more than 50% of their deposits fled. So I'm concerned that there could be more trouble ahead. Perhaps that is why the market is kind of starting to look like they're going to go higher. Jeffrey Gunlock the other day was saying, it doesn't look like we have found a high, or let's say a high in interest rates, or rather it looks, like he thinks that the treasury market is going to go higher, and he's the bond king. So yeah, he's I value his opinion greatly. So with all that out of the way, I think we could have a slow start to the week. We don't have anything too big. I mean, we have bill auctions today. And let's see here. We have Bank of England's mutton, ECB's presidents speaking later today. Nothing too big for us. Let's come over, pull up the weekly schedule, because we do have a Fed meeting this week. I don't think that we have a whole lot else, though. Let's see here. So we need to pull up the whole week. Yep, FOMC, economic projections, statement, etc., unemployment, current count, new home sales, and flash manufacturing PMI on Friday. So tomorrow we have existing home sales, but the start of this week probably going to be pretty slow. All right, so I have been kind of behind again and have some food to eat, so we're gonna just relax and eat this food and see what they do. The treasuries do look like they are raising rates. Maybe we get back to 3.5 again today. We'll see. This is gonna be really interesting. Well, I tell you what, here in the treasuries this morning, the trend is down so far, but they don't look like they're in any rush. They don't look like they're in any rush. Huh. What's confused why it was screen why I didn't have the camera on. I was doing something private. Just eating breakfast. While they're heading down, there's a big old fatty bid there at 21. Good morning, Lucas. This is gonna be an interesting day, I think. I don't know, like, here's the thing. It seems to me like the pattern the past few days has been they sell it in the morning and then in the afternoon it gets bid back up again. Like something happens and people are all scared. You know, like we were kind of doing that on Monday, or sorry, on Friday. I am still upset about Friday's discussion. It's not the discussion that upsets me. No sad, no mad. It's not the discussion itself that upsets me. What upsets me is my seeming inability to make any progress on this issue, if you could say. That's your only impression. It's actually wait, my only impression. What are you talking about? I'm frustrated that I feel like I've put through a pretty compelling set of content here to help retail traders understand why technical analysis isn't very effective. I feel like I've made plenty of things to explain why price action strategies aren't very effective. And I think that I've put together a very compelling argument as to why it's so important for us to understand what's going on with the news. And I still get people that watch, that have seen all of that content, and still don't believe it. Right, but I understand why you think that price is important, but you have yet to demonstrate a piece of empirical evidence that suggests that one price is more advantageous than another. In order for us to say that price is quote unquote important, we have to show that one of these prices is significant and that we can derive some edge off of that price. Obviously, if I'm gonna buy it, the lower that I can catch it, the better, right? We do have a small bit of evidence to suggest that there are the natural oscillations to the market, and that, you know, if you can get it on a pullback, that's advantageous to you. That's like really about it. You're too stuck in thinking I'm telling you you're wrong. I can't wrap my head around what. Yeah, here's what I think you're saying. I think what you're saying is that there are situations where it matters that I bought this price rather than that price, or rather that there are situations where I can predict that this price will be better than this price, and that I should wait for it to come to this price rather than to this price, based on where the previous swings were. But so, like, going back to this, technical analysis helps people who are in an instrument that doesn't allow them to hold 36. How do you know that? Well, so to this other part of it, which is it's all about sizing. With the right size, you can take better risks and be more price insensitive when it comes to short-term noise. Yeah. So, and that's the whole thing, is that, oh, I would like my stop be outside of the noise, because with the tools that we have, and when I say we, I mean we as retail traders in general, the tools that we have as retail traders aren't very effective at helping us deal with that noise, right? So the tools that help the professionals deal with those noise are speed and correlations and so forth, right? So you can use the correlations, that does really help, but at least in this market, not fast enough. Well, no, so again. I really think here's the thing. If you're gonna convince me of anything, you have to have like real empirical evidence, right? Because I am kind of saying here, like, if you're gonna come in and take like one tick, let's just say you're gonna take one tick. You know, let's present some empirical evidence that suggests that this is that there's a certain situation that's going to help you pick the one tick. $115.16, huh? Say that we came down there pretty quickly. Well, I mean, most of the come down was before the open, though. We've really only fallen from like maybe 21 here. That's still a decent fall. No, that is... God damn it, Uzi. How... See, this is why I'm frustrated, okay? How many times on this stream have we gone into this big long thing about what is empirical evidence and what is not? And then you just said something that would not be empirical evidence. If you go into a single market and you trade discretionarily and have success in that single market on a certain day, that is not empirical not empirical evidence. That is anecdotal evidence. What makes something empirical? What makes something empirical is other people's ability to recreate the results and verify them. Okay? So if I say that a certain set of equations can predict the velocity of a object on a ramp, rolling down a ramp, okay, then I can, it's going to be like, they're going to go through, and every time that you do that, it's going to hit that almost exactly. Now, there are some things that have randomness to them, like markets, so you're going to have to be able to do it over and over and over and over again, consistently. You as a human can't do that. You're injecting all of these other things into it and you wouldn't even realize it. For instance, you may be taking trades based on what you know about the news, and your entire edge is coming from the news and you don't even realize it. How would you know? So the only way that we can do this as an empirical study is to have some sort of a quantitative strategy or a statistical measure that we're looking for, and run it over that a set of market data, and then I could give anybody that algorithm, and anybody could go through and run that set of data. Doing it discretionarily, that ends up being anecdotal. You do something once, or you have a personal experience on something, that is anecdotal. That's what we call anecdotal. Empirical would require us to like do some math and like data science and stuff. Well, I analyze the flow at every step of movement, but I don't think that there's anything special about 17 unless I have a liquidity hole, right? So now we're talking about something that we do have some empirical evidence for, right? My application of it might not have empirical evidence, but we do have empirical evidence to suggest that certain areas become constrained. because of low latent liquidity. No, so again, like if you're gonna take a short trade here and you get short 18 versus you get short 15, of course that makes a difference as to how much money you can make, right? But what kind of information do you have that you're less likely to get adverse excursion against you if you go short at 18 versus 15? Okay, Lucas, what you're saying is not false, but it's irrelevant to the point. Okay, so if I have a predictor of order flow, right? But that's the thing. If I have a predictor of order flow that is going to move us down, right? The thing that matters the most as to how well you perform with that predictor of order flow is how early you get in, right? The less orders that have come through already, the better you're going to do. So that just tells you to do it early, right? But that doesn't tell you to get in at a certain type of price or to get in like based on like a previous pivot, right? And I guess the thing that I really have an issue with is this idea that previous pivots are actually useful. It's God. What is it about what is empirical that you don't understand? I'm telling you, you can't have it in form of consistent profits because it's a discretion factor. This is not a science. There is a lot of science involved in here. Okay, so how do I use the flow to time my entry? I'm utilizing behaviors about the market that are proven scientifically through empirical evidence and peer-reviewed studies that suggest that liquidity holds form and that it can take up to 45 minutes for those liquidity holes to heal. And I use that to time my entries, right? So there's a lot of... Okay, so if you want to understand where we get the idea of a liquidity hole from, then go and read the Walraven auction study. I mean, it didn't really come up with it from order flow. Like, I think part of my frustration has been that this is a certain thing that has kind of been like floating out there, like that I would say that retail order flow traders are like maybe on the precipice of, but they didn't really understand it correctly because they never looked at the science of it. And so their understanding of it and how to utilize it, I think, is incorrect. Well, there's a little bit of a pullback, but I don't know if they're done yet. How big of a decline has this been? Negative 22 to negative 23. So it's actually only 10K. Oh man, that is still so light. I mean, I'm on one hand, I'm kind of watching this going down and being like, well, this is the kind of move that probably I should be getting involved in and everything. But then I'm realizing, oh yeah, I really don't like getting involved when we're this light on liquidity. So see, here's how I see this whole discussion is you want to believe something, you don't have empirical evidence, so you're trying to convince me why I shouldn't use empirical evidence, because you can't prove the thing, you don't have the empirical evidence to do it. Right. I think that you believe that previous price pivots can be a useful metric in determining what is an optimal price to take. Well, that's actually coming back up a little bit better than I thought it might. 14 now. It looks like we're in the second leg of a short meta order. There are some situations, Octavius, where it's really clear that they are like multiple legs of the same order. I'm not too sure if we can say that in this particular instance. I think in particular that there was that little bit of a drop earlier in the day that, by the way, wasn't really attended by too much short volume. And now we've had this more consistent downtrend that has been accompanied by pretty consistent market selling. So what we have here is definitely a meta order. Whether it was connected to the stuff earlier in the day, I think it's a good theory, but I don't know if we have enough evidence to really run with that one in the way that we might in other situations, don't you think? What good is empirical evidence if you can't translate it into empirical okay, but are we not showing that? I think that we have shown that some of these things are effective. I mean, I think that that's kind of where there's the jump, right? Is that being able to use empirical evidence to create profits is the part that's up to you. Because you might have the empirical evidence, but there's still an amount of randomness to it and everything, right? With your qualifications for empirical evidence, your performance is easily translated into light. I think it would probably be fair to say that my performance over the last almost a year. I mean, I kind of start back in September is the period where I feel like we've been really doing this well. I think you could argue that it's luck. But why would I say that? Well, it's only 9 months of data, right? If I performed the way that I've been performing over the past 9 months, consistently for 9 years, then I would say that it's not luck. But how would you prove that? You can't, right? Now, if I took a set of 100 traders, and I had 100 of those traders take my teaching and trade off of that, and then 100 traders went off and did something else or whatever it is that they wanted to do, but just not using the information that we have, and then my set of 100 traders performed better, then I would consider that to be empirical evidence, right? No, I don't think I have proven anything performance-wise. But that's kind of the point, isn't it? Is that one person's performance can't prove that. right? That's why we look at the empirical evidence. I can't prove that you duplicating my methods will bring you money. All I can prove is that the market behaviors that we're talking about are an actual thing that are proven, right? So when you come back into, do past price pivots provide information that you can use to select a better price for your trade? That's not proven, right? A liquidity hole is proven. Price pivots aren't. Right? And why do we care? Because that's the only thing that we can really actually prove. Why don't you want to start from something that's actually proven with empirical evidence? What does a liquidity hole tell you? A liquidity hole tells you that we're probably not going anywhere for a little while. That's what a liquidity hole tells you. A liquidity hole also tells you that there is a space that you can easily get a fill. That's another thing that it tells you. Where does a liquidity hole happen at? A liquidity hole happens at an area where either they sweep through price very quickly, freaking the market makers out, or some sort of a large transaction or large number of transactions happen in a single location within a fairly short amount of time to exhaust the available latent liquidity in that location. Right. Yeah, it will happen at a specific price point, yeah. But I can't predict where that price is going to be, right? Like I can only point it out once the condition has happened. I can't really, I've tried, but I'd say you can't really predict where they're going to happen. I think that there's a great deal of randomness behind where they actually happen. No, but that is okay. If somebody looks at that series of prices and compared to past price data, so if all you have is the past prices, a time price data series, you cannot detect that condition reliably. You can't. It requires you to be able to examine the current liquidity conditions to identify. Well, I don't even really look at the time price series to see these things. I'm looking exclusively at the level 2 and the volume to see this. Not using both, but you're trying to make a specific case example that I don't think it works with this case. In this case, right? I don't think that you use the past prices to determine this. Why use both? Why not? Well, because price is mostly random. Which is okay. So let's I'll give you an example of why not. Okay. Trend is your friend. Absolutely true. If you can get ahead of a large meta order that is selling a large amount of an instrument, and you can get in early on that large meta order, you can write it and you can make profits, right? And what we do for what I do is I try to predict those meta orders and get in before they happen, right? And then I look at my cumulative delta, and I look for autocorrelation in the cumulative delta to verify that the situation that I was expecting was actually happening. Okay. Now, if I go back and I use time price to do that, and I use a moving average to determine when we're having a trend down, it doesn't work. Because within all of that, even though the flow may consistently be going a certain way, the market makers have to inject a certain amount of randomness into the market. And so price becomes unreliable in that aspect. In other words, autocorrelation in cumulative delta is a more reliable indication of a trend than autocorrelation in prices. You have a whole monitor that don't show up on screen that's full of charts. Why? So the reason that I have charts is because I need to have a chart to see my cumulative delta. I need to have a chart to see my spreads. I use this chart to see how much like actual opportunity based on range and volume, that how much opportunity there actually is in there. I have a chart to see. I guess I don't try and trade the ES, but I do just watch what the autocorrelation is. This is, I guess, something that I'm kind of more watching. And then the rest of it is just for me to be able to see what the different markets are doing, if a market is moving or not, and try and determine when it started moving so that I can possibly try and match it up with a news event, or sometimes the timing of, and the correlations in which asset went first or which assets went together, etc., can tell me something about where the money's coming to and from, and help me get a good idea of what is it that they're actually paying attention to today, right? So a time price series has its usage. Well, I would say that in most of the stuff that I was talking about there, right, I'm kind of, what I'm saying is the time price series on its own isn't very useful, but the time price series can provide context for you to be able to interpret things that are useful. Right, yeah. Okay, but there's nothing about like the place that it last turned at that I care about, right? I don't necessarily come in and say, well, this price is good and that price. When I'm doing that, I'm really more doing that from like a risk reward perspective. Like, okay, I know what the volatility of the market is, right? So the volatility is something, and when we're talking about technicals, I think that technicals are relevant when it comes to volatility. So I can look at what is the average range here, and then based on where we are at within the range, is this good risk reward? But what I don't want to do, and the thing that I'm trying to point out with people, is that where it pivoted last, which is to say, there was a little pivot up here at like 115.28.5, and then it comes down. So does that make 28.5 an important price when we come back? I think you could use it as a benchmark. But if you're trying to use it as some sort of a predictive measure of something, that's not backed by evidence, right? We can say that volatility, there are empirical behaviors based on volatility, right? Volatility tends to cluster. Volatility has fat tails. There's all sorts of things that we can sort out about volatility itself, right? But I think the thing here is that so again, if I'm getting a trend, I mean, the thing that kind of started this is like, if I have a large meta order coming in, they don't choose a price. It's inelastic. They're price insensitive. So what matters is getting in the timing, the trend right, not the price. Right? I guess I could say that. I could say timing matters more than price. Right? And the bigger issue though, I think the thing that you got to come back to is the empirical evidence, right? So we can say there's empirical evidence based on volatility, and you can try and make arguments based on that. You can try and make, whatever kind of empirical evidence that you have. But you keep trying to tell me that we don't need the empirical evidence. You're trying to convince me, well, I want to believe this a certain thing, and I don't know if I have the empirical evidence, so I think that we should just ignore it. I don't agree with that. Because what I want to do here is I want to say, for everything that we tell people, we have the empirical evidence to back it up. And if I'm making a decision based on something that I don't really have empirical evidence to back up, I need to be clear that it's just me doing what I feel. Because at the end of the day, you still kind of have to make the leap. You still kind of have to do the thing, and everybody's going to do their own thing. Well, so if I think the thing is that I think that you might be trying to use something that is based on empirical evidence. It sure kind of seems to me like that there's a bunch of other stuff that you're including in here that you think matters that's not empirical. Right? But the price has its place. I mean, I do think I think it would be incorrect to say that you shouldn't have any charts up, that you should never look at charts, for instance, right? I don't think that the past price really helps you predict anything, but it does seem to me that it gives you important context that you need in order to interpret other information. Good late morning. Is it late morning? We've only been around for 40 minutes, man. Neither does empirical evidence. Wait, I was saying it sure seems like you want to look at the chart to get your important context. And then he says, no, neither does empirical evidence. None of us can have all information. That's true. That's true. But that's kind of the point though, right, Uzi? Is that what I have to teach you guys is how to generate and interpret empirical evidence on your own so that you can do that. Because I can't do it. I can't look at every piece of empirical evidence that's out there, and I can't generate every piece of empirical evidence that's out there, right? I need you guys to be able to be doing it too and sharing it back, right? You said past prices won't help you predict anything, neither does empirical evidence. Okay, that's not true. Empirical evidence does not necessarily predict something, but it can. There can be empirical evidence of a predictive signal, right? There can be empirical, but not all empirical evidence is predictive signal. Prove it then. Well, so for instance, you could very easily prove that correlations are a thing, and that you can do arbitrage between two instruments, right? And that's something that you can empirically prove and would give you a predictive signal that would allow you to do market making with a certain degree of efficacy, right? Not all empirical evidence gives you predictive signals. And I think the interesting thing is that most of the empirical evidence that we have, it does predict things, but what it predicts is quite limited in nature, right? Like, most of the empirical evidence that we have is not along the lines of, you should take a trade at this location in this direction with this stop and this target, which is really what you're looking for, is especially technical traders, right? That's all of the components of like a well planned out trade that's planned out completely ahead of time, right? I don't think I've ever come across a piece of empirical evidence that gives you all of that information, right? But for instance, a liquidity hole, that's an empirically proven thing that tells us that price is probably going to sit there for a little while. That's something that's predictive, right? Empirical evidence of behaviors of markets doesn't translate into it's used. Well, no. So the hierarchy of the way that this should go through is, you have the data, right? Then you have forms of analysis, and we should be using empirical evidence to help us determine which forms of analysis are actually effective and are relevant in that situation, right? And then you take that information and turn that into a trading strategy. So the empirical evidence is usually not a strategy, but it can be used to formulate a strategy, right? A mountain of math PhD ain't gonna save you from being on the wrong side of a surprise headline. Well, but that's why I keep telling you guys that you probably don't want to be in the market unless you have like a strong edge, right? Because if it's nothing's actively happening, there's not like an active meta order out there in the market, then really what you're doing is you're trading the noise, and you're vulnerable to that kind of a move, right? Whereas you're less vulnerable, at the very least, if the market's already moving because of something like that, and you know that it's likely to continue because of how much volume needs to come through, right? Realize your entire approach relies on some scientists eventually coming up with some empirical evidence over a decade, unless you can run your own studies. Oh, okay. So first of all, I would give you that point in that part of the thing here is that you do have to perform your own studies. Part of the thing that I'm trying to say to you is that you need to understand this stuff well enough that you have the ability to go in and try and make your own discoveries. Right? But on the split side of that, I would also say that there is empirical research released every week. So there is a never-ending fountain of stuff that you can read to try and gain an edge from it. More than I have time to investigate. Now, I am quite skeptical of the idea that one can just read the order flow itself to predict the next few seconds or a few minutes and actually be effective with that. At least in our current markets. I think that there was a time when people were able to do that, but I don't think that there's going to be very many people able to do that effectively anymore. So there is some other empirical evidence, you know, that can give you very short-term signals, right? And robots actively trade off of those. So the problem with those is just that there's so much competition for them that understanding them can be really useful to understanding the market, but probably wouldn't be able to. No, it's not gambling these days. My proposition to you is that there is more edge available to you out there by trying to take advantage of the informational inefficiency. Using the order flow is more of a confirmation sort of a signal. You're using the order flow to help ensure that the market condition that you're looking for actually does exist. You mean research that gets disproven after some time? Well, so there's always going to be, it's just like with science, right? So are Newton's laws disproven? Well, kind of they are, right? There were some things about the theory of relativity that exposed some flaws in Newton's laws, right? But they didn't disprove Newton's laws so much as they just gave us more clarity on certain things, right? So, which is to say that solid scientific discoveries don't necessarily, it's very, very rare that we get scientific discovery that just completely contradicts everything that we thought that we knew, right? But rather it's just going to add more detail to what our understanding is, right? And I think that that's where you're at. So the thing that I find so mind-boggling that retail traders don't want to go down this path is that we live in the age of like the golden age of empirical market research, right? I mean, we've been in that age our whole lives to some extent. But the last 10 years in particular, because of some of the advances that we've had in machine learning, computing in general, and data science and so forth, we are really getting out some really strong and really interesting and compelling information about the market. For instance, the inelastic markets hypothesis, which I think is an answer for every market conundrum that people have been struggling to answer for the last 200 years, right? And that paper was only put out in 2020, in September of 2020, right? So based on empirical evidence, can we say today would be a buy or sell? So we can use empirical evidence to construct a strategy that could potentially tell us whether today is a buy or sell. Yes. Probably not today. There's so much stuff going on right now today that I wish banks could have avoided collapse by looking at empirical evidence. Well, I think that there probably is some empirical evidence out there that might have suggested certain courses of actions that the banks didn't take. Unfortunately, we probably won't get that empirical evidence until after it's over. But you have it 49 outside in Florida. It was like 50 here in Utah, so I thought it was quite nice the other day. I've started going to all of the ski stores around town and getting stuff. I got like 30% off of a pretty okay jacket. That's as far as I've taken it. I'm trying to think about what my next pickup. I think my next pickup will be a helmet. But I'm a little torn. I've been thinking about getting a helmet that has the ability to do like a walkie-talkie in it, even though I don't know if I'm going to be skiing with anybody else. Anyways. See, but again, you got to back up, because you're letting me become ADHD, and I think you guys are all going down certain paths that I understand why those are interesting to you. But what frustrates me and what I don't understand is this hesitancy towards the empirical data. What is it that you find so compelling that is not backed by empirical evidence? Why would you rather try and base your trading strategy off of that rather than empirical evidence? It's like, here you have stuff that you can actually prove, and then over here you have stuff that like people on the internet claim works, but you know, like, does it actually work? Like, because they don't have any empirical evidence. For all you know, it's just all part of you know, I'm trying to make money selling it to other people, right? Or it's like a cargo cult. I honestly think that most of what goes on in retail trading is a cargo cult, right? They don't really understand the science behind what they're doing on the market and everything, and so they're just repeating actions that maybe some guy a long time ago saw a trader do, and so they're copying it. They see other people doing it, so they're copying it, and they don't actually know the purpose behind any of it. Yeah, but I never said one but not the other. But why even waste your time? Like that's my whole point. Is you have this, there's so much time that you can spend just on the empirical evidence. Why would you bother with the other stuff? Because it seems to me that the reason people bother with the other stuff is because they lack the ability to even really do the empirical research sort of stuff, or it's you know, too hard. It's a lot easier to go and do price action, right? All I gotta do is memorize this one particular setup and then keep my emotions in check, and I can supposedly make money off of price action, versus days and days and days worth of study on math to understand the empirical research, right? Why would you go through? Because they can't afford to hit the market and put a 30 tick stop on a trade. Well, so again, you can use volatility, and there's empirical research about volatility that might help you better position your trades, right? You have to come to terms with the fact that, well, yeah, Lucas, there's only one thing that you need to make money. There's only one thing in this whole thing that you need to make money, and it will make you more money than any other thing, and that is luck. Doesn't mean that you or the next person will have such said luck and will be able to duplicate those results, right? The whole thing is, we all have an equal opportunity here to be lucky. We do. It seems to me like some people are luckier than other people, but yeah, I think that's just random. So I say you all have the ability to be just as lucky as the next guy, right? But why would you just leave it all up to luck, right? If it's all up to luck, then why don't you just flip a coin and Well, I have to say that original downturn that we had, there was definitely a meta order behind that. And it kind of looks like that meta order has subsided. I'm a little bit taken back by how quickly it snapped back, but you know, that I'm kind of always like that, and it's certainly been a lot like that lately. So we still have a very illiquid market. That means that you're going to get really fast and deep pullbacks, right? Yeah, I discuss with you strategies that consistently work over time, but you don't actually know that though, Uzi. If you come in Lucas, I was Lucas that said that. If you come in and you do something and it works consistently for 2 years, that's not enough data, right? Like markets are fat-tailed and markets have regime changes. So 2 years doesn't really tell you a whole lot. And like the whole thing is, well, you both have blue names. That's why I got you mixed up. And the whole thing is that if it is actually like a consistently profitable over time sort of a thing, then we should be able to go in and explain why and be able to find empirical evidence of the particular market inefficiency that we're talking about there, right? Right? Meanwhile, you're saying that I have to, because if my standard is 5 years, if I have to have 5 years worth of performance to know something works, right? What you're saying is I need to come in, try something for 5 years, and then it may be 2 years into it, it stops working. And then guess what? I lost 2 years, right? And how many things are there out there on the internet claiming to quote unquote work? How many of them? There's literally every effing day dozens of people on the subreddits that think they found something. We know that well over 60 to 80% of retail traders eventually blow out, give up, etc., etc. And yet they all think that they know something. What is it that makes you so sure that you have the thing that nobody else does? How much time are you going to waste on that particular thing until you find out that it doesn't work? And then if it doesn't work, then guess what? Like all that time was a waste, wasn't it? That's like 2 years you don't get back on something that doesn't work. Why would you do that to yourself? Why not just look for empirical evidence from the very beginning so that you know that the stuff that you're spending your time learning and focusing and training your brain how to see and so forth, that you know that those things are actually a thing. It's not arbitrary. Are you really going to go and put your money into a fund that doesn't have a 5 year, at least 5 year theoretical performance? Because I know I'm not. I didn't come up with that 5 years. Maybe it's arbitrary, but that's what the industry uses. You're comparing the performance between two hedge funds on some sort of, you're doing the hedge fund awards, you're going to use 5 year risk adjusted returns. The ones who know don't say, and the ones who don't say they're the ones on social media. Well, Mr. M, I think that here's what I think happens is I think that the people that actually do know something, would love to talk about it, but everybody's just too stupid, right? If I come in and I want to talk about the empirically proven evidence, the stylized behavior of order flow, sorry, I'm getting my words all jumbled up here. I want to come in and talk about the stylized behaviors of market microstructure, and even people that have been here for years would rather talk about stuff that's not proven. What's with that? Explain that. Doesn't make sense. Makes zero sense. You're trading something, but you don't actually know that. You don't actually know that. Lucas, how many times, not to be rude, but you know this has happened to you, right? How many times have you had something that you thought worked? Right? Yeah, you really don't. Have you been doing it for 5 years? Do you have, like, unless you have empirical, like if you have a strategy that you can backtest and you show it over 5 years, works really well over 5 years, and then you come in and you start testing it, forward testing it, and it's been working for you for maybe a year or whatever, I would say that would be a pretty good indication that you do actually have something. If you have market-based research, empirical evidence from a peer-reviewed study that suggests that there is a market inefficiency in a certain respect, and that strategy is designed to take advantage of that inefficiency, then you're really golden, right? But if you just think that you've seen something in the market from watching the books, and you've been trading for it for a couple of months or even up to 2 years, I would say, and it seems to be going well for you, you don't really know how effective it actually is. I don't think that you guys realize how much data is actually necessary to prove something in the market because of its fat-tailed nature, right? You literally need like tens of thousands of samples to be able to prove some of these things. Yeah, see, this is exactly my point, Lucas. I know what my risk is per bet and what my run rate, but sure, let me travel in the future and see how this does 5 years so I can decide if I keep making money now or not. Yeah, so this is exactly my point, is that because you don't know, you just have to trade it on faith and hope that it works out. And if in 2 years from now it doesn't work out, then you're back at square one and you have to go and have to find something else. Why put yourself in that situation when there is actual empirical evidence out there? And that comes back to the fundamental question that I'm asking here, is what is it that's about that's so compelling, other than the fact that you already seem to have it in your hand and think you understand it? What is it about that that's so compelling that empirical evidence is not? Why would you rather do that rather than the empirical evidence? Why would you advocate to people to try that sort of a thing rather than to study empirical evidence and come up with strategies from that? Okay, yeah, you can adapt to changes, but you still, if you have empirical evidence, you're going to be able to adapt to those changes better. I mean, the things that I'm talking about here are things that will always be a thing as long as we're using a limit order book. If we move away from using a limit order book, then all bets are off, right? I don't think that that's ever going to happen. So empirical evidence is evidence. No, Mr. M, empirical evidence is evidence that other people can verify, which means that they can consistently run a consistent experiment against it. So if I have a trading history of 2 years, that cannot be considered empirical evidence, because if you go and you trade for 2 years, I can't guarantee that you're also going to win, right? Why not? Well, market may have changed. Maybe I'm doing it better than you are. Maybe there are things that I'm incorporating that I don't realize, and so it's really hard for you to duplicate it, right? What would be empirical evidence? Well, if you had a quantitative strategy, it's all programmed up, and then I can go and run that quantitative strategy against any historical data set that I want, and I can trade it here on live data today, right? And I can prove that strategy has efficacy over a certain, 5 years is what I would look for. Then that would be empirical evidence, because anybody can go and take that strategy and run it against a data set and see how it performs, right? I can't take Lucas and see how he performs over every data set, right? don't exploit it. But what evidence do you have that really shows that it's an edge and it's not just luck? Right? Is there any? Yes, there is, Mr. M. People publish peer-reviewed studies in the on the quantitative finance section of archive.org every week that will tell you things about the market that we can prove. Why is it verboten to hold you to the same standard? What is am I not trying to utilize empirical evidence here to base my trading off of it? I mean, like I said, there's a certain point at which you have to make a jump, right? There's a certain point at which you have to say the information that I have is relevant to this particular situation, and there could be other information out there not available to me that's going to make this trade not going to work out, but I'm going to go and I'm going to take that chance. You know, there has to be that jump part, right? But I'm still utilizing a knowledge based on empirical evidence first as my platform to be able to make that jump off of, instead of just, you know, starting out in the middle of nowhere. Without 5 years of performance data, you're not. That's Uzi. That's why I don't make. Have I ever sat here on this stream ever a single time and said I'm the greatest trader ever? Everybody should follow the exact trades that I'm making because you're going to make money and so on and so forth. No, this is why I put the focus on the empirical evidence. I've been doing this for 5 years. I don't think I've been doing it this way for 5 years, and it takes a lot of practice. And you know, we're in the long game here. Okay, maybe 30 years from now we might be able to say that sort of a thing. But no, I don't. I limit my quote unquote claims to things that are actually backed by empirical evidence. Right? My invitation to you is not to come and look at these things because Seth is the greatest trader ever, but to come in and look at these things because there is empirical evidence that proves them for you instead. I'm telling you, stop looking for somebody else's performance to decide how to base your strategy. I understand that's the way that humans work, right? We're social animals, and the way that humans work is they see somebody else do something and then they try and duplicate it. Okay? There's some reasons I feel like I've gone into this a trillion times. I'm not going to go into that speech because I feel like it get too ADHD, right? But there are reasons why that sort of thing doesn't work very well in a competitive marketplace. Okay? But these things that are empirical, these are things that will always exist, that we know exist because of the structure of the market. No, Lucas, I gotta tell you what, man. If you do not understand why it's 5 years, then you really need to go back and watch a lot of the videos that I've made. I think that you've missed something very critical, okay? Or go and read Nassim Taleb's books. Okay, because 5 years is really not ridiculous. Okay, what it comes down to is that the market has fat tails. There is a large degree of kurtosis, which is the fourth movement. You do this, so if you take a formula and you derive it 4 times, and you get the different movements that end up being your statistical distribution, properties about your statistical distribution. And the fourth movement is the kurtosis, which tells you how common and how extreme uncommon events are. And markets are fat-tailed, so these are situations where the outliers can mean more than all of the other data points, right? The more kurtosis that a distribution has, okay, the more kurtosis that there is in a distribution, the more data you need to verify the actual statistical properties of the distribution. Okay. And all of these other statistical measures that we do, like averages and all this sort of stuff, they don't apply. They don't work. You can't use the average to give you very good information about a fat tail distribution. You need to use more sophisticated tools than that. You need to actually understand the distribution. Okay. So it's not arbitrary. That's just when you go and you do the math out, the number of samples that you need to actually prove an inefficiency beyond just statistical noise in a fat tail distribution requires about 10,000 trades or 5 years worth of data, depending on what kind of a strategy it is. And especially if it is a scalping strategy, you're going to need, I read it, you said, do you realize how dumb your 5-year period is, right? And so I am answering that it's not arbitrary, it's mathematically based. And I'm just saying, based on my own experience, based on my own testing and all of these other things, it's about 5 years is what you need. It's not, I didn't just come up with this shit. You're acting like I just came in one day and I was like, well, I think that it should be 5 years. So think about it. So again, I don't think that you guys are asking yourself the question that I'm trying to get you to ask. Why? Why does it bother you that it's 5 years? I'm sorry, but if it's 5 years, it's 5 years. Why? Are you going to equalize for people who trade once a week versus scalpers who yeah, so that's why I say 5 years or 10,000 trades. So if you're doing like scalping where you're taking lots of little trades, you're going to get into the tens of thousands of trades, and you're probably not going to have you might not have the kind of data that you need to be able to go back 5 years, right? But you might have the kind of data that you need for 10,000. Right? So that's why I say 5 years or 10,000. And the same with the people that are only taking like a trade like once a week. Well, with 5 years, after 5 years, you should have a couple hundred trades under your belt, and you're going to have experienced enough different types of markets, you know, to be able to, okay? So the 5 years and 10,000 trades, it's not arbitrary, guys. But again, so it's 10,000 trades. Why does that bother you? Because you don't have 5 years or 10,000 trades. Right. The question that I'm asking is, why would you rather do this than rather do this? Now, I've always kind of said 5 years or 10,000 trades, but the 10,000 trades part doesn't come up as often because most retail traders just don't have the kind of data necessary to even do that one. Like when I've back tested those strategies, I need more than 1 or 2 years of data usually. And my broker won't send me further back for like what do we call it, historical bid ask prices. They don't go further back than 2 years. So because we are all retarded gamblers. I don't remember that kind of stuff. Like the thing is that I have come down through, I mean, I have back tested so much stuff. I mean, it's really, when I go into my NinjaTrader and I see, like, I can't even remember what these were all about, right? And I'll come back into one of them like, oh, this one was about this, but let's try doing it this way now. And I'll add a little bit to it for the hell of it. And then guess what? It still doesn't work. It's just like, I got like 2 things from all of that I think are actually worthwhile, right? And even then, I'd say that it's fairly mild and that you would need more edge. You'd want to combine it with other edges. All of this backtesting, no point to it. Base it on pool of trades, not years. Well, let me say it this way then. So 10,000 trades and at least 3 years. Because here's what I find happens, and I've seen it so many times. I don't know why it comes down to 2 years, but that's just what seems to happen. And I run across so many people that they think they're doing well up until the 2 years, and then they blow up. If you are taking on excessive risk, so that is to say that there is no explicit edge behind what you are doing, other than that your risk reward ratio is really skewed, so that you don't run into that losing streak very often. I have found that it takes you about 2 years to run into it. And that's why you're able to see so many people that they claim they're profitable, right? And they make it 2 years and then they blow up. So I wouldn't, I don't think I could say that that's empirical, which is not to say that we couldn't prove it empirically. It's just that we don't really have the accurate enough data on it, right? So we'd have to say, but I think that if we did have accurate enough data on it, I think that you would see huge drop off in the first year of people that give up, right? And then there would be a little bit of a plateau, and then between 2 and 3 years there'd be another drop off. That other drop off being the people that don't that are taking excessive risk. Well, I'm not making a claim about a strategy, am I? Well, yes, I am. But I guess what I'm saying though is there is some backing in here in terms of based on what we know about fat tails, and when you kind of go and do the math, kind of what the distributions look like and how many trades you have, because you can quantify that. You can quantify based on the distribution how many trades you actually need to be able to see the distribution. Okay. And I'm extrapolating based on that, so then here, so I'm taking that as my base, and now I'm adding some anecdotal experience on top of that, which is that I run into people almost every week, it seems like, that think they're profitable, and they've always been trading for about 2 years. Sorry, anecdotal. I feel that everyone has their own theory and not necessarily others would agree or follow it. Well, sure, but yeah. It still comes down to it's the meta argument is what this is, right? You understand that this is a meta argument, right? So the argument is not what is effective. The argument is what is effective at finding what is effective, right? Remember, meta is information, data about the data, right? So what is effective at finding what is effective? And what I'm hearing is, I looked at the market for a while and I found some sort of statistical aberration I think exists, and I've been having a little bit of success with it. That's what I'm hearing. And my contention is that what is effective at finding what is effective is starting with your base on empirical evidence. And my question to you is, if you've been listening to me for a long time and you're not trying to use that empirical evidence as the basis for your strategy, why not? What is it about the thing that you found, or that you think you found, that makes you confident that it actually is going to be effective in the long run? Because markets, because of their fat-tailed nature, you really have to take this for the long haul, right? So if you're going to go and you find something and then trade it until it stops working, and then go and try something else and then trade that until it stops working, you can only do that so many times, right? You're only going to be able to do that a few dozen times in your lifetime. There's just only so much time in your life, right? And I don't want you guys to come in and end up, being 30 and finding that the strategies that you had aren't really working, and still not having had the success that you wanted, and then coming back and saying, oh, here's this empirical evidence that I could have been looking at and learning and focusing on for the last 30 years. Things that I at least know are actually real proven things about the market. Right? How would you say pancakes wrong? How to do that to get the advantage? Well, I say that if you get good at studying and generating your own empirical evidence, I think that what happens is, as you go through that process, is you kind of learn the process of where the edges are actually going to be. Oh my gosh, how did we come back down so fast? Holy crap. I was so absorbed that I missed. Okay, so it's only been 3 minutes. Still, wowzer. That pullback, I was kind of, when we were at 22, totally would have been a great place to go short, huh? Because now, remember earlier when Octavius was saying, well, I don't, it kind of looks like another leg of a meta order, but we're not too sure. I'd have to say, really, really good chance that leg was the second leg of the meta order that we saw earlier, man. Now, one of the things is, we have autocorrelation in order flow, right? We have, how do I freaking... We have autocorrelation in the order flow going down here, right? Leg 1, leg 2. I would also say, well, okay, so there was a little bit of a shift here at this point in oil. I'm not sure. We did see the dollar move a little bit lower, so that might be related, but yeah, I think but that was a bid. Well, so I'm saying this downturn right here was leg 1, maybe possibly leg 2, because there was this earlier stuff too, but I'd say it's hard to tell on this one. So let's just, to be safe, let's say this was leg 1. This right here was the post meta order regime change, right? So as they're waiting, and then look, this ended at about 7 o'clock. And then when did it start turning back down? About 45 minutes later, a little bit earlier than 45 minutes. So you take like 45 minutes in that, or take 20 minutes around it. Right? So if I think I'm still in sit and watch mode, but if we believe that there's going to be a second leg of meta order, then up there at 24 would have been a great place to take it. And well, actually 22, because when we came back up, there was a liquidity hole around 22 and a lot of volume traded there. So probably the place that we should have taken our trade was 22. It would have been a good trade. Would have been a good trade. Because anyways, the thing that I guess I'm getting at is that I feel that people would rather not use the empirical evidence, because it's either too hard or there's something about it. It says something about the world that they don't like. I think that second one is a larger stumbling block than we might realize, because what the empirical evidence kind of suggests is that markets are fatally flawed in some respects. That's not to say that like we should move over to communism or that we need a completely different financial system or anything like that. I think there's certain things about the financial system that make it that the financial system is optimal for those things. And so the rest are just kind of the downsides of selecting that we kind of have to deal with when it happens. Like we've been doing the last 2 weeks, right? But suggests that the market is not informationally efficient and that there's some fatal flaws in it, and that we're always going to have problems and issues that we have to overcome. What is the empirical evidence? I don't get it. My English is not the best. Okay, so empiricism is the basis of wait, let me try and use less sophisticated words here, okay? Empirical evidence is what science is founded on. Okay? Empirical evidence is what science is founded on. Okay, so the problem used to be that somebody would say something like, oh, some life just spontaneously generates, right? Clearly it makes sense. I've used this model about the world and it's been effective for me, right? And then somebody would come along with a microscope and find out, oh, actually there's these microscopic organisms that we can't even see, and that kind of is what causes fungus to grow and so forth, right? So how did they get around that problem? Empiricism. Empiricism means evidence that other people can look at and verify. Okay? That means that I can give you this algorithm. You can run the algorithm against any data set that you want and verify that the behavior about markets that we're talking about is actually a real behavior, right? That's what we mean by empirical evidence, right? So the problem is that people, our brains, the frontal lobe of our brain is a neural network, okay? Neural networks are really good at taking input data and making quick inferences about them, right? But when we are trying to do like deep analytical work, we have to kind of revert to, it's still part of your frontal lobe, but it's slower, more methodical systems, right? So what happens is we want to use those heuristics, and the strongest heuristic that we have that humans utilize is watch somebody else do it and try and copy what they're doing. Right? So the person's tendency is, I'm going to go and find the person that's been the most successful in day trading and try and copy their method. So what happens with that? Well, the people that perform the best, it's usually for one of two reasons. If you really truly outperform the market, you really truly outperform the market, there's three situations. Okay. Situation number one is your Renaissance capital. Okay. Situation number one is your Renaissance capital. Situation number two is you are really fucking lucky. And situation number three is you are using excessive risk and you don't realize how risky what you're doing actually is. So when people follow those heuristics, they are always led to the most aggressive, luck-based, high-risk strategies. right? And I think that this is a major factor behind why so many retail traders fail. It's because the natural inclination of the person is to not go for empirical evidence. The natural inclination is, I'm going to find somebody who knows what they're doing. I'm going to read their book, and then I'm going to learn, everything that I need to don't know about trading, right? I don't think I ever argued against the empirical evidence for the stylized behavior of market microstructure. Well, I think that's accurate. You definitely did not argue against it, but I'm not getting the like, I believe it in my heart sort of a thing, right? What I hear is like, so I got in a big argument with my wife yesterday. I was probably too aggressive with it, but my son pulls apples out of the fridge and will take like 3 or 4 bites out of them and then just leave them sitting around. My 3-year-old, okay? I consider this a serious issue. One, because we never have enough apples. And then he gets really upset when we don't have apples. So we're not utilizing the apples that we have very, very well. And 2, because I feel that he is developing modes of behavior that will be very socially unacceptable later in his life. And he's autistic somewhat. So like every little thing that we can do to try and help him out and be more acceptable to other people, the better off he's going to be. And I feel like this is one we need to nip in the butt, right? But the problem is that my wife has always been laid back. I look at the way that she raised the 3 kids that she had before me. She's very laid back with them. She wants to let them do whatever it is that they're feeling like they're doing. She wants them to have complete access to her at all times, right? So the baby never learns to go to sleep on their own. Like these kids haven't learned to go to sleep on their own until they're like 10, 12. Like before that, she has to like sit with them. And if I put the baby down, oh my gosh. Because she went on a business trip this weekend for training. She's a flight attendant. And I was up till 3 o'clock trying to get that baby to go to sleep. Because every time that I would put him in the crib, he would realize that he was being put in the crib and freak out. And he knows that mom's not around, so that upsets him too, because he doesn't want to go to sleep without mom, right? That's the way that she is. And so she thinks if he wants to just eat the raw apple, he should be allowed to. And I say, no, it's very important to me that we cut the apple up for him. To the point that he refuses to eat it unless it's cut up. Right? Because he's a little autistic. That's the way that he will probably become, is he will not want to eat it unless it's been cut up for him. Right? But she doesn't want to do that. And so I've had this argument with her many, many times. And what happens is she just kind of says what she knows will kind of make me shut up about it. And then not change. Like never agree to changing anything. Right? So this time I got her like, just say it. I will make every effort to cut the apples when I see him with one. Right? Oh, it took a lot of work to get her to say that, but that's because I'm an asshole. And when I'm being an asshole, you don't want to be like, oh, and then if I say it, then I'm proving him right. I get it. Okay. But I feel like I'm getting the same thing here, is that we don't actually, the whole like empirical approach thing to it, that we should focus on the empirical evidence and not on our individual performance of it. That our own individual performance will come along if we rely on and we learn as much about the empirical evidence as we can, right? I don't get that sense from people. And that's what frustrates me. What frustrates me is that it sounds to me like you guys would all very much prefer that I come in here and take big trades and YOLO in on all of the things, make huge amounts of money, scale up as quickly as I can, turn this into $1 million. And then once I've turned it into $1 million, then it will be like, well, I have to do it too. That's what I feel like that people want me to do. That's what I feel like YouTube wants me to do. And I don't want to do that. I want to, because I don't think that that would help you. I think that I could probably come in and get lucky eventually doing it long enough and make pretty big profits. And yeah, I would probably blow up along the way, but everybody would forget about when I blew up along the way. But would it actually be helping you? Would it actually be helping you guys find strategies that are actually in line with like how the market actually does behave and are actually sustainable and will last more than 2 years? It wouldn't. It wouldn't. It would be detrimental to that. Right? I'm frustrated because I don't feel like anybody else is on board with that vision. Oh, I didn't lose that argument, Lucas. It's maybe more like you win the argument, but at what cost? Once you make those millions, you would disappear from YouTube? No. So if I made those millions, the YouTube channel would change. For sure. Problem with this is you project the average retail trader onto us and argue from that some of us are not. Well, that may be true, but I don't know if that really gets back to the heart of the thing that bothers me, right? Because the thing that bothers me is that I don't feel like that people are truly, see the vision. Now, if all of the sudden the YouTube channel took off, I mean, I would probably stow a lot of it away, right? Like I would at the very least try and make sure that like my tax advantaged retirement accounts are like maxed out and stuff like that. And not, we're talking about like, we're like Graham Stephan level YouTube channel now at this point, right? Okay. And then the rest of it I would use to create better content. And I would attempt to more generalize the things, because the reality is that I've given you guys most of the best information that we have. I hope that we find some other really, really great things that we can like really dive into, but the more of those things that we find, the less likely that we are to find some of those in the future. They're going to become harder and more rare. That's just kind of the nature of it, right? But there's all sorts of applications to this information that we can make at higher time frames. There's all sorts of things that we can, So for instance, right now we're having this financial crisis. Well, not everybody's trading the financial crisis, but it's still relevant to them. It's going to affect their jobs. I've definitely watching LinkedIn and like the requests that I get on LinkedIn, it's changed the last month in particular. So I do think that people are probably having a more difficult time finding jobs now, for instance. These sorts of things are relevant to them for those reasons. So we could use this information that we have to help them understand better about the financial system and be able to make better personal decisions too, right? So that's the way that I would take it if we just continue to expand. Something along the lines of, if you're running your mouth on predictions and forecasts in this market and you aren't making a shitload of money, you need to shut them the fuck up. I mean, that's again, that's like a comment that makes me go like, well, okay, I guess people aren't sold on the vision. The people would rather see me be a degenerate gambler and make tons of money rather than focus on what can we actually prove empirically. Because if it's empirical, if it's actually proven, Right. It comes down to the kind of like success on the stream itself, not the YouTube channel in general. I think that the YouTube channel we're doing pretty good, but like on the stream itself, yeah, it seems like the stream's never going to be very big, that the stream is never going to get to like hundreds of viewers consistently sorts of behavior unless Seth has become a millionaire, I guess. That just means that the stream will always be small because I'm not here to necessarily become a millionaire. No, I'm only here to use the knowledge that I do have to be the best trader that I can be, and that's it. Some people want their brains to be their clout. Others want their wallets. You're no different. You want to be super smart shepherd that leads us sheep. No. Why do you think that okay, so I do not share this information with you because I think that it makes me look super smart and I'm the leader of this shepherding this gang, etc., etc. No, I don't think so. I share this knowledge with you because it's tough stuff. And there's more to research than I have the ability to do it. Right? That's why it pisses me off. Because what I want to have happen is, hey, Seth, I read this paper this weekend. You should read it. It's really good. That's what would make my day. Is here's a piece of empirical evidence we have that we can actually work from. Or Seth, hey, I did this back test and this back test results are actually really compelling. So we might actually have discovered something here, right? That's what would make me excited, right? I am sharing this information with you so that you are capable of contributing. There's a certain base level of knowledge about this stuff that we need to have. In order to really even know what's, like once we understand the empirically proven behaviors of market microstructure, that'll really help you narrow down where you should actually do your research and so forth. Then it will really help you understand the new research that does come out because it all kind of builds on itself, right? That's why I'm doing it, so that you can have a collaborative community. Seems a failure on my part that I have not been able to create that. Instead, I have a community that likes me as a person and likes the company and so forth, but is not really here to do that, and would be more entertained if we were making big bets and big money. Well, yeah, I want people that are actually trading their real money because we need the experience that comes with that. But I want people that are trading their real money, utilizing the empirical evidence that they have and constantly striving to discover new empirical evidence that we can use together. Well, look, the reality of it is that if you're trading responsibly, the profits are never going to be spectacular, guys. Okay. The making millions of dollars, that's why so many people fail. Like, I'm coming in here and I'm like, look, if you look at the last 9 months, I've made my mistakes. There's still a lot of work to go, but it's pretty good. It's pretty consistently to the upside over a 9-month period. That's pretty good. right? But because it's not $1 million, nobody gives a shit, right? Because I'm just trying to say, like, look, you can come in and just make $20, right? Because look, I know that most of you don't have $100,000 to blow. Like, you might be able to find $100,000, but if you lost that $100,000, you'd probably be pretty unhappy about it, right? And that's kind of the amount of money that I think that it takes for this stuff to really scale, and you know. I have gone tilt and lost the whole accounts for sure. Hasn't happened in a long time though. Switching over to the micros really helped with that. Like, I at the end of the day, I mean, I did get tilted and so forth. I used to think, oh, I'm so much worse on tilt than the average person. I don't know if that's true. I think I seem to have this threshold where it's like, when I do tilt, you know, I have to go to a certain point until I'm tilting. So I go from like normal to like tilted. It seems like just like all of a sudden you're at level, you know, DEFCON 5 or whatever the deal is. But how I perform when I'm actually on tilt, I don't know if that's actually worse than your average person. But what I do think was that I was not properly sized in general. So when I did tilt, it was almost guaranteed to destroy the account, and that's no longer the case. So now I can make bad decisions, and still be fine, and you know, everything else is made up for it, and I can kind of focus more on getting rid of those mistakes more than anything, to just really bring out like more spectacular performance. But there's a point when you were more collaborative with the audience. Yeah, well, but I think that was kind of because I realized that what we were all collaborating about was bullshit. It wasn't bullshit, but I was still sold on this idea that I could just learn to read the DOM, and that's all I needed to make money. That's what it really come down to, right? That was what changed. Yeah. So I realized it was a mistake. It wasn't like the worst mistake in the world. We still learned a lot from it, and it's still useful information, but ultimately there was a good deal of time spent trying to be profitable just from watching the DOM and thinking that John Grady setups and some other thing that I'm going to intuitively discover on my own would actually bring those profits. Yeah, and well, you go ahead and try it, but like what I realized was why I was spinning my wheels, right? Was all of a sudden, because what really changed it, there was 3 points that changed it, right? The first was after the pandemic, because I did so well that summer. I was like, well, I was trading on sim, and because I had blown an account, right? And if I had kept that, I would have done amazing. So I was probably lucky, because I would have been up like $20,000-$30,000 otherwise. But then I wouldn't have kept looking and learned all these things. So I did really well with that. And then all of a sudden I came into this period where it was just absolutely dismal. Like May was amazing and June was terrible. Oh my gosh. Right. And that was the point at which I said, I'm sick of like backtesting all these strategies. They don't work. And, you know, because we were doing like the time confluence thing. I think that's actually like really useful from like being able to understand what's going on from a high level view all at once. But the actual setups that we were deriving from that didn't work. The actual setups didn't work. And So then I said, I'm so tired of this. I'm just going to trade the news. I have a news squawk now. I'm just going to listen to the news and I'm just going to trade that. I started doing better because I did that. And then I finished reading the Trades, Quotes, and Prices book. So then that made it change, because then all of the things that I thought I knew about order flow, I was able to kind of prune that to be like, okay, here are the things that we actually do know, and here's the stuff that was actually bullshit. And here's the things that maybe they're true, but we can't really be sure. But there was a lot of things that I kind of realized, like, well, I believed this, but it's not true. Based on what we know about the microstructure, is probably not true. And then the final straw was the inelastic markets paper, because the inelastic markets paper was where we got to the point of, oh, okay, I used to think that if we go high, the higher we go, the greater and greater incentive there is for them to sell it. And, you know, the more strongly and the more likely we are to mean revert. It's not true. That's what the inelastic markets paper says. The inelastic markets paper says that the market is going to move according to whether people are buying or selling. And if people come in and buy it up, it's going to move up, and then it's just going to stay there. They leave it, it'll come back a little bit, and then it just stays there. Right? And that's how the market actually works. At that point, I was like, if I had gone back and gone to the empirical evidence from the very beginning, if I had found that gateway to empirical evidence from the very beginning, I would have saved myself 3 years. And the frustrating thing about it is that I was told. The traders at Goldman told me about this stuff. You just search Gabiax and Koigen, or watch the inelastic markets video. I show you the paper in there as well. They told me about this stuff, but I didn't have enough context about it to know that, like, I need to go to archive.org and read these papers and all that sort of stuff, right? So it was kind of like, well, okay, now I know the gateway and nobody else is talking about this, so I'm going to talk about it, and we're going to create a community where we can collaborate about this sort of stuff, where we can talk about the serialized behavior markets, we can talk about these studies, and we can use that information to try and trade, and we can all be reading different things and finding different information all the time and collaborating and getting better. It hasn't happened because people don't want to actually collaborate about that. It's too hard, too much work. Or there's something about it they just don't like. Grady is just reading the DOM and not running backtests on empirical evidence. Okay, so yes. So the thing I will say about John Grady's material is that the setups that he talks about are things that you are going to see. It's not like he goes in and says, when this happens, this is what is likely to happen. Instead, he talks about the situations that you will see on the DOM, and you will see those situations. That's just because of how this game works. That's just kind of what happens. So you can kind of explain logically why those things happen. But as for it being a predictive signal, it's not, and I don't know if he really says that it is. So, like, day after day, there is always an excuse not to take a trade. This is just like what I said. You guys want me to come in. You want me to take a trade every day. You want me to always be in a trade. You want me to push them as hard as I can. You want me to YOLO into them and scale up onto them. If I was doing all that, I'll be happy, but you wouldn't be learning anything. Like seriously, if you want to see people trade, go to Matt's stream. I don't understand why you would stick here. No, I take plenty of trades, Lucas. I still take several trades a week. Okay. You're not even analyzing the market anymore? Well, that's because I understand that there are certain periods where our ability to analyze this are just really limited, right? right? I'm no longer under the delusion that all of this past data will effectively predict the future, right? I know that I need to have active information and that I don't always have that, right? You're still clinging to this fantasy where you look at these setups and you find them and they're going to tell you what's going to happen and you can come in and make money every day and all this sort of stuff. It's like, not really. It's never going to happen. It's not actually how the market works. Well, that's what happens if one sim trades. I've had a lot of opportunities this past 2 weeks, right? I have, but I'm not going to trade it with this amount of volatility. This is too much volatility for my account. So that's what I've got to do. I've learned that lesson way too many times. It would be a disservice to, it would be a disservice to myself to be trying to aggressively trade it right now. Had a couple of subs that I didn't have the balls to take it. You know, I love it when there's some sort of tweet or zero hedge story or a piece of information that we can talk about that could potentially provide us trades, right? Like, I've been really frustrated over this past week, you know, and I guess this has made me even more reluctant to trade. That, like, oh, well, so for instance, we had all of this stuff about Credit Suisse but being bought out by UBS over the weekend that basically turned into a, if they can't put a deal together before the end of the weekend, the market's just going to completely fall apart tomorrow, right? Why were we not on that on Friday? The information just hasn't been there for me. How will you learn if you don't try different approaches? Well, we should be trying different approaches all the time. I'm just saying, only try the approaches that have empirical evidence, right? Like, your choice is this. Like, really, you're done with the stream. The market is closed. You have some free time today, and you decide that you're going to spend that free time on trying to become a better trader. You have two choices. You can go on Reddit and see what people are saying that's popular, or go on YouTube and see what the top YouTube videos are and trying to duplicate their strategies and then seeing if they work for you. Or you can go and read the empirical side of things. You can go to archive.org, find a paper to read, and learn everything that you can about that paper. And what bothers me is that everybody chooses to go and watch the YouTube videos and read Reddit. What's the point of funneling that information into the chat? I don't know. That's why I'm frustrated, Uzi. Because it's not working the way that I thought it would. Yeah, you're all the average dumb retail trader in here. I mean, I'm not here, you know, you're not all, because I do get people ask me about the book, and they do get the book and they are reading it. Right? But have you read the book? Oh, I only watch you and he read it. Yeah. Trading Bunny's reading it. You're right. Trading Bunny has been somebody that's really trying hard. And then the second question, if you have read the book, then the second question I would ask is, when was the last time that you went to archive? And then if the answer to that is like yesterday, then the next question is, then why aren't you sharing stuff that you found with us? Oh, you read Mark? No. That video, that is completely different. If that's the video that, here, let me pull it up here. Well, you could share it on Discord. You could share it here. This book right here, Trading in Exchanges Market Microstructure for Practitioners, is different. This is not well, I think they do get into some quantitative stuff and everything, but this book is more about how is the stock market actually structured, because it doesn't all just go through the exchange. And so this kind of market microstructure is a little bit different from like the stylized behaviors of market microstructure that I'm talking about in quant finance. I mean, they are still market microstructure. I'm just saying what I'm talking about is really more of a specific subsegment of market microstructure, which is quantitative properties of markets that we arrive at because of the market microstructure. Oh, is Lagarde gonna speak? Yeah, she is speaking right now. You know what? I don't think I turned my news squawk on, so I've probably been missing shit. There's no trade-off between price and financial stability is what she's saying right now. We'll see if Powell sings the same tune on Wednesday, right? I don't think I've ever been more uncertain about a Federal Reserve meeting. You're setting a standard of being a quant and a programmer for your audience, and you can have a really hard time, maybe. But that's really what I feel like you gotta have to really be successful at this. I don't know how you do it. Well, no, that's not true. Because there's so much informational inefficiency, right? That's the other side of it, is you can be the quant or you can be really savvy with the news, right? But I don't hear you guys sharing stuff about the news very often either. You do. It's not as, I think we could do better on there. But I mean, that's always going to be the thing, is it's only going to get harder, right? Is it never going to get the channel to where you want it to be ever? Yeah. Well, but that comes back to this whole thing that, like, I didn't set out to be like, I would like to start a YouTube channel and a business with a YouTube channel. What would be the best business to go into with the YouTube channel? Oh, how about day trading? I could start taking that approach. It sure makes me feel like it should be that way. Yeah, you have to work with us for what we are and not expect us to be you. I don't think you actually want that, though. I don't think you actually want that. If that's what I did, what would make me different from any of these other people on YouTube that are already doing it that way? Right? You have a knowledge base they don't have? Well, I mean, that's the first thing that you've said that's made me feel like maybe this isn't hopeless. But I mean, that's the whole thing, is that I don't feel like the knowledge base is necessarily appreciated as much as it should be. Created Ninja script course, but I did well. You know, the Ninja script thing is really difficult because I made 3 videos at the very, very beginning on Ninja script that in reality give you all of the information that you really need. But with that, would come a lot of study and trying to figure things out on your own, right? And I did not create a course that really holds your hand through it, and I'm not sure if I know how I would make it a course like that, because a lot of programming is doing things and learning the way of figuring it out, right? I would really like to, so, you know, we're talking about like if we were having the success, we would have to change things, you know? One of the things is that I would like to create a lot more content that is based on informational inefficiencies that we might have in analysis of the current news and the markets and so forth. And I would love to have the ability to make more content like that. When I've tried doing it, those videos haven't done very well, and maybe I just need to keep working at it. But, you know, I would like at some point for it to be like, you know, subscribers get those exclusive videos on that sort of stuff. I would love to do that. You want to be, well, I don't know if the teaching the ninja script thing is like, so like I could go and I could make like a 20 video series on programming in ninja script. I'm just not confident that would help people. Like the stuff that I'm really confident will help people, the stuff that will get you up and going the fastest, though, I made those videos. It's difficult to interact with with anything someone says grants a request to be empirically proven. Well, it is if you're not in on the empirical stuff, like because if did you notice, because you pointed out a couple of times where I said something and you said, well, that's not 100% empirically proven, and then I said, well, okay, that's true, but here's kind of the information that we do have that's proven that might lead to that result, and here's maybe some ways that if we had more resources we might be able to empirically prove it, right? That's would be the kind of response that I would want to see, right? It's like, well, how could we devise an experiment to prove it empirically, right? You know things about apples. I do. I've been studying, been tasting all of the different apples and keeping notes. I mean, I do think at some point, and I don't think that now is really the appropriate time to be making this shift, but at some point we are going to have to take on a little bit more risk with our trades and so forth. But like, how easy would it be to focus on a particular aspect of market microstructure each day you trade? Maybe. I guess so. I mean, I don't really plan them out, do I? And I could plan them out further than I do. I do, you know, the other side here is that there is stuff about just what's going on in the market itself that we need to spend more time talking about too. Oh, there's not enough time to freaking do everything, man. Indicator package. So now the indicator package. So here's the issue with the indicator package. There's a maybe a threefold problem. Problem number one, though, is that there's a lot of indicators in there that are really sophisticated. So like, I have a video I go into all of them, but like, it's kind of boring. People don't really, you know. So like, problem number one is getting people interested in the indicator package. I think that those of you guys that really understand it, you have been getting it, and we do sell the indicator package from time to time. But then the other issue that I've got that's kind of holding me back on that one is NinjaTrader, man. NinjaTrader has just been like, ugh. If I have hope that Jigsaw will get those sorts of features soon, and then when we do, then I probably will try and make a video about them. I don't know if it will be the best video, but I'm gonna try giving it a shot. The synthetic dollar alone in that package, thank you. You're trading money, you totally get it. I appreciate it. Don't upgrade whatever you do. To name today's video the Apple crisis. I gave a little bit more detail on that whole situation than I probably should have, didn't I? that was probably the ADHD tendency to overshare. I think, you know, here's the other thing about this is that I'm not convinced that people don't want to learn these things, that people can't learn these things, that we can't get more people interested in it, etc., etc. So I feel like a lot of this conversation has kind of turned into me blaming you guys for not doing these things, and I apologize that it comes off that way, but in my mind I view it more as a failure of myself than a failure of my audience. I think that you guys are all pretty smart in general and everything, and that's why it's like I'm like, well, I talk about these things all the time, etc., etc. The only explanation for why I'm still getting some of the questions and comments that I do is a failure on Seth's part. That Seth is not have the magical charisma in order to explain these things in a way that people are just so magically attracted to it that they want to pour their whole being into it. I'm not that person. And you would say, well, you can become that person. I've been trying. I'm not sure I can do it. You know what I mean? I need like Bill Clinton charisma. I don't know if I'm ever gonna have that. I never heard of the term microstructure until I saw your videos and then wanted to go that path because it's science-based and not subjective. Oh, I appreciate that. Well, you've poured 16 years of your life into trading. Plenty of people, I mean, the monetary incentive alone is enough to entice people into wasting their whole lives in it, even if they never see it. Oh man, Newsy, I mean, I know that you've had some success with it, but man, I especially early on, oh man, there's this one guy, and it was always like, oh, let's add this thing to a footprint chart. Let's add this thing. Let's do all of this sort of stuff. And I was always like, well, why would that be useful or not? Well, we'll just make it. It just never ended. And he had been trading for well over like 20 years or something like that and had never had success with it. I was just like, wow. My issue with all the trading gurus is that they're not certain about the causes and reasons why they do what they do. It is subjective. I think that there are probably a lot of guys out there that have had a lot of so I would cite Anthony Crudelli as I think is one of these people. I think that there are things that Anthony Crudelli understands about the market that he doesn't realize he knows. Because when I hear him talk about how he decides to trade, he still kind of talks about it in the sense of like a technical analysis kind of an approach. But then when I hear him talk about his trades, and I hear him talk about the current markets and trading in general, and it doesn't sound like that's how he trades. Like it seems to me like he has been in the market long enough to intuitively understand the empirical stylized behaviors of markets without actually knowing them, you know? Like the neural network has figured it out, but the mind is not conscious of it. You have people that trade naked and look at price action, but there's no explanation about why price delivers the way it does. There has been a lot of that, although the most recent iteration of price action, which they call smart money concepts, is not like that. So there is this line of price action out there that you were talking about it the other day, the ICT stuff. They call it smart money concepts, and it's basically based all around the idea that the market maker is there to screw you over. And so what they want to do is they want to push the market through a liquidity zone so that they can get filled up with all of their liquidity. It's all a ruse to screw you over, sort of a thing. And there is a lot of things about what they say that contradicts what we know from the market microstructure in some degree. Especially this whole thing that, like, okay, if they're going to push it through that liquidity zone, how are they going to do that? They're going to use market orders, and then if they're going to use market orders and they're immediately going to turn around and sell it, then it's going to go lower than they started. And so how do they make money from that? Right? They don't have answers for those kinds of questions. But they did create like a philosophy, I guess you could say, to approach why the market behaves that way. But it's still based on like some sort of a psychology based thing, right? Whereas the market microstructure is like happens because of the structure of the market, right? The screw over concept was something I believed when I started trading. Yeah. I mean, don't get me wrong, the market does kind of have a tendency to screw you over, but it's not like a conspiracy or anything. It's just kind of the way it happens because it's competitive. I don't see the difference between smart money and informed traders. Oh, okay, so here is the difference in what he calls smart money concepts and what I deem as an informed trader. So smart money to them, it has more to do with that they have a lot of money and they know how to mess with people. And so they're going to somehow make the market move in this certain pattern that messes people up. But we've discovered what that pattern is. And so we know how to take advantage of it when they do it, sort of a thing, right? Informed trading means that a trader knows a piece of information that the rest of the market doesn't, that would be highly predictive of where things are going to go. So for instance, if you knew that Credit Suisse was going to have to be bought out by UBS and that it was going to be very hard to get that deal done, and that in the end Credit Suisse was going to not even be half of what it was on Friday, right? I was really shocked by how much money they were willing to, like, the shareholders got screwed. You know, it was a smart thing. I don't know if the Saudis should have come out and been like, well, we're not going to put any money out and made an official announcement or anything. I don't understand why that went through the way that it went. Yes, exactly. Nancy Pelosi is an informed trader. She is trading on information she knows that is highly likely to predict the future orders, but is still public information. It's not confidential, you know, it's not stuff that you can get prosecuted for trading. She knows information about these companies just from knowing enough about the industry from being in Congress to be able to make these trades. She is an informed trader, 100%. I just don't like to go down that way because I don't want informed trader to become synonymous with inside trader or something like that, right? There is information out there available that's public and that you can find that or whatever reason gets ignored or doesn't get priced incorrectly, right? So those opportunities are there for everybody. They're everywhere. They're literally littered on the floor every day all over the place. I might not be able to find them every day, but I think that they're there.
ECB Sensino says the latest developments in the European banking sector give us confidence in the decisions taken.
Right. Yeah, inside trading. I mean, inside trading, an insider trader is an informed trader. That's true. I think one ill-discussed topic may be that most of the market action we see is exit activity and not entry activity. Do you have empirical evidence to that effect? I mean, so first of all, theoretically, entries shouldn't be more or less impactful than exits. So whether they're an entry or an exit probably shouldn't matter.
Banks are well in excess of requirements.
But I don't know. Would the institutional trader be considered an informed trader because they alone know the size of their order and what the impact will be? Oh, that's a good question. I'm gonna say, I mean, there's lots of different kinds of institutional traders, but if we're talking about the institutional block trader, they are not themselves informed, but they are trading on behalf of an informed trader. So they might as well be informed. I don't know. It kind of makes sense, but I don't know. Well, you'd have to explain why the theory is that more of the movement would be from exits. I think my own approach to that would be that it seems to me that more positions are opened at the beginning of a contract and closed at the end of a contract, and that most of the activity in between is intraday hedging. And I think that most of the activity that we see here in the morning is buying. And that most of the exiting is done towards the end of the day when we're not here. But, and the empirical evidence I would use to cite that is that we know that the vast majority of positions in futures are intraday. So that's what I'm basing that off of. Yeah, I think there's a point in time where most of the activity is entry position, but as the contract acts on, it's people adjusting by exiting. Yeah, but the caveat to that would be that the majority of the activity is still intraday trading. So. But we're looking more for the meta orders, and I think that those meta orders are not intraday trades. So then that would be here at the beginning of the contract, most likely entries. But I guess it depends on the situation. Right now, we're getting some pretty heavy squeezes, right? So probably there has been a lot of exiting over the past 2 weeks. Makes sense that they would want to exit as quickly as possible. Well, I mean, for these big guys, they would much rather exit when it's moving against them, right? It's like if you have it long and you got a good winner and it's time to get out, you would much prefer to exit when it's still going up. So. Today's meta order may not be tomorrow's meta order. There you go. Well, to that point, the last meta order ended at 8:12. So that means that you could see another leg here at the top of the hour. I think there's probably a good chance that we will see another little bit of a move down, but it's probably going to be really iffy at this point, because once you get to like the third or fourth leg, it kind of gets kind of difficult like that, where like it does go lower, but only like a tiny bit lower. So let's see. Now you explain that. How do you see that to the audience? Because so you have like, as the meta order drags on, you get the square root law of meta order impact, and that same law is going to apply to the orders, which is why on Almgren and Chris, they have it be, you know, if you're risk adverse, the most common thing that Almgren and Chris will tell you to do is to sell half of it first, and then a quarter of a second, and then eighth of it last, and then the rest of it. So, a specific time, because that was 45 minutes from the end of the last major meta order, and it takes about 45 minutes for the liquidity to recover. So I would say that at this time, the market liquidity is in a healthy, the healthiest state that you're going to get in this kind of a market, and that means that the markets could move either way here, but that if we think that they're still going to sell, they're they could sell and they could break through here, but there's probably not going to be as many orders behind it as the earlier waves. So it's probably not going to go as far. Right. And I'm using my knowledge of Almgren, Chris, and the square root law to make those determinations. Or you could just use the heuristic, which is the earlier you get your money, the better. Because it only gets harder as the day goes on. Okay, I do got to go though, guys. So I will see you tomorrow. In the meantime, stay